I'm recording.
Hey, Michael Hopkins here, Director of Strategic Content of the Contributor and Community Content team at Seeking Alpha. I have Jennifer Warren from Concept Elemental here with me this morning. How are you?
Good, thanks. Good to see you, Michael.
Good to
Yes,
see you too.
you're in Denver, I guess. So
Yes, I'm
yeah,
in Denver, just outside of Denver, and you're in Dallas.
yes. Where it's
I do.
all happening. all the shale stuff, right?
Right,
So,
exactly. And I did get a chance to read the article in D Magazine in Dallas there. Very good article on George Yates and Heiko and some of the other developments going on, not only here in the US, but mostly about what happens in Europe as well too. It's a very good article. Thought it was really well done.
thanks. There's a lot of work. I guess the sort of backstory that you're after a little bit is that so this story came together basically, first of all, as you know, on Seeking Alpha, I've been chronicling the oil shale boom. I started in like late 2013 when I heard from Pioneer Natural Resources that they were going to be, starting to hit the Permian, whereas they had been in the Eagle Ford before. I mean, the natural gas shale revolution had already been happening, and prices petered out because they produced too much. But then the shale oil boom was happening. It was, the onset in the Permian. It had already started in the Basin. So I've been chronicling that for since 2006.
Yeah,
And then on Seeking Alpha in 2013. And and there's like almost 200 articles on your site about it, just chronicling those developments. But so I talked, George Yates is someone I've known for a while. And we had a lunch a year ago, roughly today. It was right after my last year's energy edition in D. And he said he was doing things in Europe. And so I said, well, let's talk at the new year. So we had a conversation in January of this year. And he had given a talk discussing, at that point, Europe was already showing the pains of high prices. It was before Ukraine was invaded by Russia. And he was saying then that, Europe needs to produce their own indigenous resources because they've become very dependent on Russia. And then lo and behold, the invasion happened. I pitched this, idea, and I, knowing that the energy awards were going to be coming up, because I typically do the feature for that. And so all these forces converged. And so since May, it's been nonstop just having to keep up with developments because things have changed so much. We didn't know, at one time we thought maybe this war would end soon and everybody would go back to, Europe buying Russia's gas and, but anyway, so that's kind of what happened and how it all came together. And George he started doing, he was actually ahead of George Mitchell in the Barnett, developing, trying to hydraulic frack on the Delaware side of the Permian. And this was back in the 80s. And he was working with these scientists from Los Alamos lab trying to crack the code on hydraulic fracking. His family, his grandfather is considered the father of the New Mexico oil industry from a 1924 well. So 100 years later, here we are. and so this story happens a lot, the beginnings of it in the Delaware Basin, because that's where George Yates cut his teeth on, production, learning geology, but he translated it internationally and started doing things in Spain like 15, 20 years ago, and in the UK. So that's how that kind of came together. And now it's a big part of the solution for Europe, you know, hence the I'll show you later, hence the, you know, the line solving Europe's energy crisis, kind of, you know, in the near term anyway, maybe long term. So
what I think was surprising is that not only, I mean, when the invasion happened, I mean, there was this big focus all of a sudden on Europe's energy needs. But I mean, when you read the article, this has been, I mean, people like George and probably others have been saw the potential there for quite some time.
oh yeah, I mean, well, the Bowland Shale in the UK is actually larger than the Haynesville and the Marcellus Shale put together. That is how much onshore gas resources the UK has. And there was a moratorium. So what they had been fighting, you know, the headwind they had been fighting in the UK was that there was a moratorium on large scale fracking, you know, and drilling, hydraulic fracking, drilling. And then once the Ukraine invasion happened, you know, it just so happened that Yates was giving a presentation on developing their own resources March 8th, while President Zelensky was about to be piped in, you know, on a video from his bunker. So George was right there at that time, trying to convince them that, you know, this can be done safely. We have all the experience, the world, the technology, the know-how, the ability, the capability to do hydraulic fracking safely. We've been doing it for like, I mean, it's been being done forever, you know, very long time, decades, but, you know, we've been really at it hard, you know, since 2005, 6, and it's just gotten, you know, better over time. We're not having issues per se that I'm aware of, and, you know, with safety and whatnot. And the other thing too is producing your own resources. Even hydraulic fracking has less carbon footprint than importing LNG. So, you know, so Putin won with his disinformation campaign that he started like 15 years ago. It's still ringing in the halls of Washington and Europe, you know, especially now. And the UK, they reversed this moratorium under the Truss administration, Prime Minister Truss, who just resigned. Now the new prime minister is going to roll that back and reinstate the moratorium. This just happened within the last day or so. And so this article discusses what the UK could do with, like, in Spain, with, no, it's the UK, 100 wells. They were developed 100 wells. It would reduce imports by 10%. 100 wells, you know. Anyway, and you know, there's going to be a lot of subsidies. The government's going to have to spend a ton of money, and that's short term, right? That's short term and political. Germany's doing the same thing. They're about to spend 200 billion euros, you know, to subsidize consumers and business, and they, you know, it has to happen right now because there's a crisis and people have to have a buffer, you know. Jay Hatfield and I just talked about that yesterday afternoon on a video, and that's on my YouTube channel too, because we were trying to update a little bit just what was going on with natural gas. So
when reading the article, I mean, I get some ideas about some key takeaways, but can you describe some of the key takeaways for investors? Maybe, I mean, some opportunity there, something they should look at?
Sure. I know we've talked about how, you know, energy is only one of the largest industries in the world. It is a vital industry because it makes the world work. It's why we don't freeze at night. It's why we stay cool in the day. It's why we can operate. It's why we can be on our cell phones all day and, post to, LinkedIn, it's all these things. It underlies everything, and were it not for energy, the development of energy, which happened during the Industrial Revolution around the 1850s, we wouldn't be where we are today. We wouldn't have the standard of living, the lifestyle that we have today. We wouldn't be advanced to the state that we are. So it's pretty fundamental. And right now, I think like 82% of primary energy demand is met by fossil fuels. By 2050, we're going to need 50% more energy because of population growth, economic development. Fundamental. Large energy players, have been, like the majors, and then the large independents, majors such as ExxonMobil, Chevron, BP, Total, Shell. And you have the European majors going, they've been trying to, increasingly follow more of the alternative sustainability path. But you have the US majors, and I think this is what's interesting, and large independents like Pioneer and Devon and EOG. They're also trying to produce resources more sustainably. I mean, everyone got the memo on carbon, they're trying to make their operations greener, emitting less carbon. And I think over time, there's going to be opportunity in the technology that will help us, produce resources more efficiently, and that applies to oil and gas, and produce wind and solar more efficiently, because there's land use issues, there's supply chain issues, there's mineral scarcity issues. We're going to have to think about how to do this more efficiently. So I think there's a lot of opportunity for, small cap, medium cap firms that are in that energy tech space. And I think you're going to see large firms, eating up those smaller firms over time, where you've got more of a integrated supply chain. And I talk about this on Seeking Alpha, the whole supply chain investment thesis. It's a real thing to look at. And I had that confirmed, actually. I was at a lunch yesterday on crypto, and everyone just wanted to talk about Ukraine and energy. And one of the speakers was saying that really smart, probably the smartest woman I've ever met and heard from, actually. And I've heard a lot of smart men and smart women. She was really smart. And someone asked her, what's one of your concerns, just in general and related to everything, energy, crypto, whatever. And she said supply chain issues, and we're seeing that revealed, right? And this is both from a business point of view, I think, and a geopolitical point of view. So there's a code to be cracked, on this. And I think players with large capital, can influence that. So I don't know if I answered your question.
No, I think that's great. I mean, I think it's also when we think about just what firms might do well, given the situation in Europe. I mean, we talk about small cap, medium caps, private companies, public companies. Maybe there's some names you want to toss out there.
Sure. I mean, I haven't looked lately at BP's investor presentations, but they have a good foothold in Europe, obviously in the UK, and I think they're trying to do things more sustainably. I don't know how they're pivoting given the Ukraine situation, but also Total, TTE, you know, they had a record third quarter, I believe, because of LNG, you know, LNG sales. The LNG from a US side of things, you know, we have capacity constraints. You know, there's only so much going out. It's increasing, and I like some of the pipeline firms that have really you know, good coverage that goes to the Gulf Coast and that is connected to like the Haynesville and the Permian. You know, there's some constraints with the Marcellus. They can only get so much gas out. So that production is happening in these parts. So you've got to look at, you know, who is, you know, who is changing their weightings of producing oil and or natural gas. That's one thing to look at on independents that are more like US focused. I know EOG is, you know, there's a lot of activity in that Delaware side. We can look at some of my, I can screen share for
Sure.
if you want to do that, and that would probably speed up this. Okay, just a second. I had a folder handy. Okay, and don't let me forget, we got to get back to the chart heard around the world at some point. That was really people were very interested in that at the Energy Awards. It was, you know, 200 people, executives in the energy space, publicly traded and private firms in North Texas, who are deeply connected to the Permian and the rest of the world. And this chart, they were very keen to know what it was about. So we'll get back to that. But so this is just kind of showing, this is interesting. You talk about opportunity. So this is from Rystad, and it's about untapped oil resources. And if you see the black part, which is untapped, the US has a lot of untapped resource. We have pretty decent low, you know, break evens because we're not having to send part of our budget to run a whole country, right? We're a market economy. We're not a autocratic society. The market works here. I think we've talked about that. And the market working is really a key issue with what's going on in energy and how politicians need to respond. Now, you said you want to see some names. Okay, well, let me show you this first, just so we know where we're looking at. Okay, so here's the Permian.
I love the map. I love those maps.
Yeah, and this one doesn't have, you know, like the Midland over here on this side. This is like the New Mexico side. Okay, there's a lot of activity where Texas and New Mexico meet, which is the Delaware Basin. So in that part of the Permian, I saw this on some research by a government body, and it was showing where all this increased rig count and activity was. And I can say, because I've looked at those numbers for the last, you know, several years, but that area seemed to be getting hit more, you know, like more production was going on there. There's more activity. So this is the region here, Eddy and Lee County. Okay, and now how that translates into firms, I looked up who was doing what. So the top producing operators in Lee County that I can just pick off that are publicly traded, EOG obviously has a lot of production. Matador Resources, Occidental, Oxy, Chevron, Apache. So those are all, this one that's really large is private, Mewbourne Oil. And then if we go to Eddy County, okay, Apache, Chevron. These are all the big players. Devon. Devon's interesting, and I recently purchased some Devon stock because they're in a lot of good places, and they have a good yield as well. EOG also in Eddy County. And then here at the bottom, XTO, which is Exxon. Yeah, XTO is their unconventional resources group. So Exxon is producing quite a bit there as well.
And I'm assuming these companies continue to grow from quarter to quarter, month to month, year to year in this particular area.
Well, here's the deal. Okay, so about growth.
Yeah.
Okay, so I'll just show you this chart. We'll get back to the growth thing. So basically this is showing, and it's on my website, how Europe here in 2003 was producing almost 60% of their own gas resources, and it went down to 20% by 2020. That's a big decrease in self-sufficiency. So what did they start doing? Okay, this is dependence on Russia. In 2003, there was 20% importing from Russia. This is the EU and the UK. By 2020, it was almost 35%. So they were not, and then if you look here in 2014, here's the first Ukraine invasion, which is interesting. So the EU became less self-sufficient, producing less of their own resources, and started importing more from Russia. And Putin's disinformation campaign to block US shale development started, back here, like, I don't know, in this area. He knew energy better than policymakers. So I'm going to stop sharing, and then you had a question. What was your question?
Well, I think that just looking at those firms, it was a very interesting list of those working with Basin. And I'm just assuming they're just going to keep growing.
Okay, here's the growth. Okay, here's what's at the growth issue. Okay, so okay, growth is constrained in terms of producing like they did back in the beginning of, the growth you saw, that kind of growth. What's happening now is it's not growth, it's dividends. It's oil prices are higher. They're producing at a modest growth rate, because before, when they were growing faster, they weren't able to give that back to the shareholders, right? So now we have higher oil prices, and like Pioneer, I can't remember, I just saw that they declared like a $5.50 per share dividend. Their yield is, I can't remember if it's 8% or 9% or something like that, PXD. So and that is because there's a couple of things. So we're in an environment of tight oil supplies in general. Every country is pumping as much as they can. And there was underinvestment happening for some number of years, partly driven by ESG concerns and concerns that, oh, well, if the world is trying to get off oil and gas, we better slow it down. A, the money wasn't flowing, and B, shareholder demands were different. And so now what's happening is they're not growing as fast. They're growing moderately, but oil prices are high, and they're probably going to stay high because of tight supply, lack of spare capacity, the war situation. Even with the recession talk, there's expectation that Europe will face recession in this year, next year. Their oil demand growth isn't what's driving it. It's developing country demand growth that's driving the increased need for energy supplies. So that's one factor. So basically, publicly traded companies are having to return cash back to the shareholders. And that was all sort of documented last year in my article then about Pioneer. It set up what is still happening. So if you want to see that setup, just read last year's article. And then the other thing I think when we're talking about opportunity, because this is a key point in the article, is that what has been revealed is this new natural gas world. And in the past, natural gas was traded, consumed. It was more regional blocks, whereas oil is global, fungible, ship it all over the world. Gas is volatile, more difficult to ship. So there's been constraints in the past, and hence the regional blocks, like Russia supplies Europe, and we supply a lot of our own now, and Canada is in there, and it's just regional blocks. But now what we have is the globalization of natural gas, and LNG is reflecting that. And you see a lot of activity in Europe trying to build terminals so they can receive LNG from different places, whether it's the US, Qatar, Middle East, because they're not getting it from Russia as much, and they're probably not going to. It's going to be interesting to see what happens when this ever finally ends.
Yeah.
But basically what I can see is that the natural gas map is being redrawn, and yes, the US oil and gas industry will benefit as long as policy doesn't get in the way. Policy getting in the way impedes what would naturally happen with the market. And we see this in Europe. Policy's in the way, and that is why they have had really high prices. And yes, absolutely, Russia blew up the playbook, but policy kicked the ball, to start with, and now these dominoes are falling, and George and I talk about this in that 10-minute video, where we discuss the politics of this, the policy of it, and what is happening. Because it's what's happening is it's creating energy insecurity and potentially food insecurity. They go hand in hand. And so there's a lot of challenges that can be met by innovative firms and forward-thinking firms in all these spaces, because energy is connected to everything: tech, food, industrial processes, all activity. It underlies all activity. So that's where I have 75% of my investment portfolio, and then the other part is tech, and some of that energy portfolio is also some sustainable infrastructure funds, resources focused, because I do look at energy, but I look at connected resources. I look at the whole resources nexus, which includes energy, water, land, And then that spreads out to everything. And it's like a big fat, network, right?
So when we look at this, obviously there's all this interconnection, and it's not just we're looking at things that happens here in the U.S. We're looking at what happens globally. And one of the things we talked about prior to this call is how does U.S. production play a role, specifically with publicly traded firms?
Right. Well, I mean, I think the majors like ExxonMobil, Chevron, and the ones I've named, I mean, I think they're well set up around the world. They're diversified. Not only do they have production in the United States, but they have production, and I know that Exxon does things in Papua New Guinea and I mean all over the world, right? I mean, I haven't, because I've been so focused on the macro, I haven't gotten into the weeds of all the players, that are doing this and that are going to benefit, because there's a lot. But what I'm doing is I'm pointing the way, I mean, if you just look at the map, look at who's doing what, look at these investor presentations, see who has production where, look at what's happening. We know where the choke points are, we know where the headwinds are. You can work it out, I think fairly easily. But the majors, safe, to me, those are safer bets. US independence, to me, because I follow it, others might see that as riskier. I do not, because there's also a really strong bullish case, bar none, of US oil and gas production. And those are the independents, the E&Ps, plus, the oil field services firms, the big players. And then there's some that are more, US focused. I think Liberty is one that's kind of interesting. I used to have their stock a while back, and I just wasn't in. That's just not my wheelhouse. There's certain segments that aren't my wheelhouse. I really, really, really focus on the macro issues and the fundamentals connected to that, because I see things physically in flows. I'm a flow person. And so that's how I, chart what I'm looking at, basically. And that has to do with production and basins and, data supporting all that as well. I mean, I'm not just like throwing a dart. But I have my bellwethers, and anyway.
So maybe we can wrap this up here with, the more general question. If we're looking at just, if we're looking at macro, but also, I mean, a very powerful chart, that chart heard around the world.
Yeah.
Going back with the article as well too. Maybe just sum up, why is energy important? We talked a little bit about that it's connected to everything, but maybe people don't realize how important and crucial this business really is.
Yeah. Well, I mean, if you just look at it practically, okay, what part of your household budget goes to your electricity company? What part goes into the gas tank? And we're not even aware of it because it's just happening. One way to get aware of it is to see what's going on in Europe. Because of these extremely high prices in Germany, there are firms that are going bankrupt. There are firms that might have put a plant or a facility on the continent that are now thinking, oh, you know what, we're gonna build that in North America, so that's jobs. There is some, onshoring trend going on in energy as well, but it's connected to other things. We saw that Inflation Reduction Act, there was a lot of money, thrown to energy transition type players. the government realizes that, you know, we've got to spend some money, and yeah, some's going to get wasted, to develop the technologies of the future, to help move the needle on that. So I think that's a signal, you know, that kind of money being thrown at you know, to see what sticks. You know, is it wind? Is it solar? Is it carbon capture? Is it hydrogen? Is it ocean wave technology? Is it all of the above? You know, and I'm watching all that movement as well. So it's not just oil and gas, even though it's a huge part. You know, there's the renewables part, but I like the you know, I like the setup for US oil and gas for, you know, some are saying it's constructive for 5 years, some say 10 years, you know, so it's not just short-term thinking on that. And so I think the market gets a bit impractical, you know, in you know, and here's the other thing I think is, you know, relative to energy's importance, I think given everything that's going on, I think fund managers need to reprogram their algorithms, you know, because they're going to miss it.
Right.
But
It seems like it's this long-term story. It's not just something, I don't even think it goes on 5 years. I think it goes 10 and maybe even longer than that.
no, I'll be dead and it's still going to be going on.
Right. Yeah.
You know, but hopefully I've helped, you know, bring some information to light about, because we hear all this in the media all the time, and you know, if you read the media, and I don't care what media you read, it's all of it, you know, everything, you know, it's built around, oh, BP's doing this in, you know, in Uruguay, and you know, oh, this is a trend, you know. So you can really get confused about what's really happening on the ground, what's really running things and powering things, who's powering things, who are the players, versus the spin and the narratives and the things that make a good story. I'm trying to do the stories that are really happening, based on data, based on reality. And that means it's going to be unpopular, some, you know, and it's going to be contrarian, some. But, you know, I think the Texas concept in Dallas, I think there's like a middle path. You know, I talk to people on the West Coast, I talk to people on the East Coast, investors on both sides. I hear what's going on, I hear the thinking. And I feel like in the middle, there's this pragmatic middle. And I think it's kind of represented here. And I think that's what that story is a reflection of, you know, like what's the reality, you know, you can get married to your ideals, but do you want to freeze, or do you want to solve the problem? If you're worried about carbon, if you're worried about global warming, we'll come up with some proper solutions, and let's work with reality and advance, you know, the dialogue, and advance, you know, society, and keep the globe running.
So let me just ask one quick Seeking Alpha question.
Sure.
What do you want to communicate to the Seeking Alpha community about what's going on?
Well,
the article too.
Well, I think the article's worth reading because it'll really give you an insight about, and it's going to be online supposedly Monday, but I know we're going to post something on my page, so we'll get a link in there too. And I've been telegraphing this. It's all over my site. I've been chronicling everything that's coming in videos, blog posts. You know, and this is all my research. All my research that goes into this is all over my site. So I've been like chronicling this. So if people on Seeking Alpha want to, you know, want some research, and I've left a trail of breadcrumbs basically. And I'm doing this too because I know that retail investors, some types of institutional investors, they're more at the mercy of public firms. You know, they don't have opportunity to go, you know, invest privately. Some do, of course. And so I think having better information, and maybe the information that the private players have, maybe the information that the institutions have, maybe the information that's not just a news flash, you know, and a headline. This is deeper work, and I've been at this for a long time. I've been, you know, chronicling and trying to make sense and analyzing the shale development and what it means for global energy markets, you know, for, like I said, since like 2005, 6, really heavily 2013, once it became the oil, you know, shale revolution in the United States. So, so I think, you know, there's a breadcrumb trail. There's a lot of information that people can inform themselves and try to identify an investment strategy or just some firms that they can, you know, feel good about. So.
That's great. And I'll say that this is coming out in D Magazine in
Yeah,
Dallas.
DCEO magazine. So if you Google probably Monday, you know, my name, DCEO Energy, you're probably going to, and George Yates, put George Yates in there, you're probably going to pull up that, you know, so.
And that would be on Halloween, October 2022.
Ooh, that's scary. I love that.
Jennifer, thanks for the time again. Jennifer Warren, Concept Elemental, great Seeking Alpha contributor. I appreciate your time today talking about this stuff, and congrats on the article. It's a really good article.
Thanks for having me, Michael. I enjoyed it. All right, bye.
See ya.